Biggest mistakes I see investors make is treating the stock market like a casino, jumping in and out, chasing the latest hot pick, reacting to every headline. My approach is the exact opposite. I'm building wealth slowly, on purpose, and with a strategy that's designed to work for decades, not just the next earnings season. When I buy a company, I'm not just buying a ticker symbol, I'm buying a business, one I expect to be bigger, stronger, and more profitable 10 years from now than it is today. And to make it into my portfolio, a company has to check 4 boxes. The first box is pricing power. If a business can raise prices without losing customers, that's a huge advantage. It means they're offering something so valuable that people are willing to pay more for it year after year. Think of Amazon with Prime. The subscription keeps going up, and yet people stick with it because the service is just that embedded in their lives. Or MasterCard. You can't really quit paying them when you swipe your card. Pricing power protects margins and keeps profits growing. Second, I want strong organic growth. I'm not interested in a company that's standing still or relying only on acquisitions to survive. I want to see demand for their core product or service growing naturally without them having to buy growth. Take Alphabet, for example. Their advertising business and YouTube user base keep expanding organically, and their cloud segment is growing fast without them having to constantly acquire competitors. Third, I look for a wide moat. That's Warren Buffett's term for a competitive advantage that keeps rivals from eating your lunch. Moats can be network effects, brand trust, scale, intellectual property, or switching costs. ASML is a perfect example. They basically have a monopoly on the machines that make the most advanced semiconductors. No one else can do what they do at that level. That's an unshakable moat. I made a full video about it. You can check the link in the description. And fourth, I want consistent free cash flow per share growth. Free cash flow is what's left after a company pays its bills and invests in itself. It's the money they can use to buy back shares, pay dividends, or reinvest into even more growth. On a per share basis, it shows me whether the value is actually flowing to shareholders. S&P Global, for instance, is a machine when it comes to generating free cash flow, and they've been growing it steadily for years. But here's the thing. Finding these companies is only half the job. The other half is about me as the investor. I have to be long-term focused, disciplined, unemotional, and patient. That means I'm not checking my portfolio every 5 minutes. I'm not selling just because a stock dips. And I'm definitely not buying because something is trending on social media. My job is to stick to my process even when the market is volatile, and trust that over time, quality wins. When it comes to buying, I wait for moments when great businesses are undervalued. That doesn't mean finding the cheapest stock. It means finding the best stock at a fair or discounted price. Sometimes that happens when the market overreacts to short-term problems. For example, I've added to positions when the market was pessimistic, even though the long-term story was unchanged. That's when you get those opportunities to buy a compounding machine at a bargain. I also make sure the businesses I buy aren't at serious risk of being disrupted. I'm not interested in companies where one new technology could wipe them out. I want steady, reliable growth. Sure, they'll adapt and evolve over time, but the core business model has to be rock solid. Now, selling is rare for me, but it does happen. I'll sell if the competitive landscape changes too much, if a company loses its moat, or if new rivals start eating into their market share. I'll also sell if my original thesis turns out to be wrong. That's part of being disciplined, admitting when something didn't work out and moving the capital to a better idea. At the end of the day, this strategy is about building a portfolio of businesses that can quietly grow my wealth in the background. I'm not chasing hype, I'm not trying to guess the next big thing, and I'm not here to outsmart the market every week. I'm building a compounding engine, one that works while I sleep. It's not flashy, it's not going to make headlines, but focusing on pricing power, organic growth, strong moats, and free cash flow per share growth combined with patience and discipline is how real wealth is built in the market. I apply this same checklist to every stock I own, whether it's a tech giant like Amazon or Alphabet, a niche leader like ASML, or a financial powerhouse like S&P Global. Different industries, same principles. And by staying focused on the process instead of the noise, I can let time do the heavy lifting. So that's my investing philosophy in a nutshell. Buy the best businesses when they're undervalued, hold them for as long as the thesis is intact, and sell only when the story changes. Everything else, just market noise. Thanks for watching. See you in the next one.